Hey everyone, it is Thursday, and that means another expert interview in our series that we do 4 times a week. And because it's Thursday, it means we're bringing back Matt Seamus. How you doing, Matt?
I'm doing great, Michael. How are you?
I'm doing very well. We had talked about doing this one last week. I was whining and crying because I had a weekend of taxes ahead of me, which, oh, by the way, I didn't get home to almost 1 a.m. On what would it have been? I guess it would have been Monday morning, right? Because it would have been Sunday through Monday. So, a long day. But I think we got to jump in and talk about these market swings first, at least a little bit, right? I think we've had our 4,000 point move, and today is off to an interesting start. So why don't we give that a little bit of love and attention, and then we'll jump into the meat of taxes. What's this market? What do you see?
I mean, a lot of volatility, clearly, and fear-based. This, to me, fear-based decision making, largely based on coronavirus and the uncertainty around how much of an impact that's going to have on the economy, on each country's individual economy, and then globally on the economy. You know, we saw earlier this week the Fed had an emergency session to cut interest rates 50 basis points. That hasn't happened since 2008.
Yeah.
That's a big deal.
Yeah.
And that's in direct response to coronavirus. And typically a cut like that might fuel more optimism in the stock market and equity markets. And you just, day to day, you just can't quite tell what's going on. And it's not clear what is driving a 700 or 800 point swing in either direction on any given day. There's a lot of fear, clearly, for people. And so that's kind of my recap of what happened, or what is happening. And then I think, we should probably talk about the implications to real estate,
Yeah.
which are, to
Yeah.
me.
One sec. So real quick, I want to talk about sort of what I see, and then we'll talk about the impacts of real estate, because that's really all I care about, right? I'm not going to buy a stock because the market is up 1,000 or down 1,000, right? I actually got asked the other day from a friend of mine who's been watching me invest, who calls me a crisis investor. That's what he calls me, right? He goes, "You're not a real estate guy. You're a crisis investor." He said, "What would it take for you to buy stocks?" I looked at him and said, "The Dow's at, call it 25,000. I said, "If the Dow got to 12,000, I might buy." And he's like, "Oh my God." And I said, "Remember, right, when the stock market crashed to 6,000 or 6,689 or whatever it was, I bought Ford, Citigroup, and Blackstone were my 3 acquisitions back then. I didn't hold them nearly long enough, right? I'm very clear. I'm not a great stock market person, but when there's fear in the streets, yeah, I'll put some money to work." But yeah, so just because the market's down 4,000 in a week, it's nowhere close to where I would look at it. So I'm not a stock guy. But I actually propose that the 4,000 point week had very little to do with the coronavirus. Now, I know that is extreme. I thought it did too when it was happening. What I think was happening is the power players, whatever you want to call them, were starting to actually believe that Bernie Sanders had a chance, and they were scared. And then when Super Tuesday comes and, Biden has a decent showing and it sort of coalesces around him with 3 people dropping out, the market goes up. And more specifically, why I feel that way is because of what happened to UHG, right? UHG was getting hammered because essentially healthcare for all kill the insurance companies, right? That came back 10% in a day. So I'm under the belief that we haven't had the blowout week because of the virus, because we really haven't had meaningful earnings cut yet. They're coming. I have a lot of friends in the Valley that are talking to me about sales pipelines and things of that nature just drying up. And I think that's still coming. So I don't know. Maybe I'm reading too much into things. I look at this stuff too much, but that's what I saw.
That's interesting. Yeah, I don't know. I mean, I'm certainly not an expert. It's my opinion and your opinion. I mean, I think the political race certainly, definitely has something to do with the volatility and what's going on.
Yeah.
And coronavirus and the Democratic primary kind of are happening
Hmm.
in parallel.
Yeah.
So and our like human brains want to associate a cause with an effect. So
Yeah.
we're always looking for answers of why. So
Yeah.
why the stock market moves, why things happen.
Yeah. So we're not
Uh,
stock guys. So let's talk about real estate. This is a thing we have experience. We look at every day. We make, decisions on. What do you think the impact is? Let's stay with the coronavirus. What do you see? What do you see the impact is? Because I have some thoughts there as well.
well, one thing that, like just as a preamble to
Sure.
this is one thing that does create a lot of volatility in the stock market is uncertainty about the
Yes.
future.
Yep.
And so that's why I think coronavirus, like it's an extreme uncertainty. There's really no telling how long it will go on and what the economic impacts will be. It's probably a little bit easier to quantify what the impact would be of a particular candidate being nominated as the Democratic candidate and then even potentially elected. But so I think uncertainty fuels this fear, and then fear fuels these kind of irrational decisions.
Mm-hmm.
And fear generally fuels this flight to safety, and investors wanting to move their equity into safe assets, relatively safe assets. So one thing that I look at, looks like you have something to say.
Yeah, well, I think the other thing, it's not only the flight to safety, and this actually comes from Sam Zell's discussion this morning on CNBC. It's delayed decisions, right? If you were looking to buy a house in Los Gatos or Los Altos and pony up $400,000 and sign up for a $1.6 million mortgage, are you likely to do that in an environment of great uncertainty? No, you might delay that a little while, right? So he talked about a deal, right? Sam Zell, multi-billionaire, he's delaying a transaction because he just doesn't know. And I'm like, oh my God, that's exactly what's going to happen at the mom and pop level in real estate. At least that's my belief.
Yeah, interesting. Yeah, no, I think there's definitely something to that. So the 10-year Treasury hit an all-time low.
Yeah,
And
under
I don't know
one.
what it's at. Yeah, under 1%. I don't know what it's at this morning, but the 10-year Treasury is kind of like the ultimate flight to safety.
Yes.
And so that price or the yield generally comes down as more people move their money into treasuries. And so the interesting thing, at least for me as a commercial real estate buyer and owner, is generally the 10-year Treasury is the interest rate I can get on new debt is correlated to the 10-year Treasury and to LIBOR. There's a few different things. But as the 10-year Treasury gets hammered, it means that the lenders are going to be willing to offer a lower interest rate for deals that I have in contract. So we're in an interesting moment. We have 4 deals in contract right now.
Oh, wow.
And
good timing.
Across the board, we are going to get much better pricing on our debt than we thought we were going to get, even 3 weeks ago.
Yeah. Can you share that? I'm actually looking at refining one of my commercial properties. What kind of rates are you getting? Are you getting sub 4?
So it just, this is like caveat, completely depends. Like everything on the situation, the asset class, the location, all that stuff.
Of course.
Yeah, you can definitely get sub 4% on multifamily. Yeah, definitely you can get sub 4.
Wow.
You might be in the mid 3s.
All right. Well, I'm going to be refining some debt.
if you own, so we're buying a 136 unit multifamily property in Virginia. And we're probably looking at 3.25% or maybe even lower.
5 or 7 year, or what's the?
That's 7-year fixed rate, interest only for a few years. That's Fannie Mae debt. So it's about as good as the terms get. 30-year amortization. Wow. But just the point is that we are pricing for debt is more favorable today because of this uncertainty about the economic future. And that makes it a good time to borrow.
For sure. Yeah, no, I mean, the deal you locked a month ago or whatever the time was, it looks better today because the debt structure is better today.
Exactly right. But the one thing that I will mention, because this is how I think about real estate, is long term.
Mm-hmm. Of course.
And when you have this fear-based volatility in the market that isn't based on fundamentals, the market is essentially creating this opportunity for you because of all this volatility.
Yeah.
If you have a longer term mindset and you're looking at fundamentals,
Yeah.
then you're going to see little buying opportunities in this volatility. And I think this is just an example.
I totally agree. I believe kind of exactly what you structured there for multifamily, but I believe it's true even in single family. Kind of my earlier talk about Sam Zell and delayed decisions, mom and pop Los Altos, is I firmly believe by the end of March, it may not be happening right now because we got less than 100 cases and it's not yet crazy, but my guess is the owner occupant buyer is going to go on strike April, May, and maybe June. What that means for me is inventory will pile up in April, and it means I will be able to find the motivated sellers easier in May and June, and I will buy a lot of single family homes in May and June. That's my current thesis of the chessboard that I see.
Oh, that's great. So what are you doing to load the gun so that in May and June you're ready?
I've been building my cash stack. It will be by the end of March, it will be the largest stack I have. Plus I am relining up private investors in my 6 and 20 program. I'd essentially turned off because I have enough capital. There's not enough deals out there. I just couldn't place the money, but I'm reaching out to people going, hey, I might be very active May, June, maybe July. If you're still in, let's do it again. So I've lined up a couple of $1 million. I have a decent pile myself. So the gun is loaded and I have extra clips.
Nice.
Yeah.
Nice. Since you mentioned it, what's your 6 and 20 program out of curiosity?
So what I've done is I've raised private money a couple of times back in, I don't know what it was, 2009, 2010, after Bear Stearns went out. I borrowed at 10%. People had money. They were afraid of their money markets. I borrowed at 10%. This time around, people want to be part of the action. So what I do is I borrow at 6% interest only, right? The purchase price. I still fund all the repairs and all of that. I don't borrow everything, just the purchase price. And then I pay 6% interest only. And then when I'm done, I exit, usually less than 6 months. I give them 20% of the profit, hence 6 and 20. I just created a program that was good for them, good for me. People like it. They've averaged, double-digit returns, when you amortize it over a year or whatever. So it's fun.
Yeah. That's great. Okay, interesting. And how do you structure that? Is that
they're the lender.
Secured.
Absolutely.
They're the first.
They're the first, secured, named on insurance. I go through escrow twice. I buy cash first, clean title, everything, and then I basically refi, right? Right. So I buy cash first. I go through escrow twice. I know it's an extra $1,500, but it just, I feel better about it doing it that way.
Okay, cool. I like that. Thanks for explaining.
Yeah, very cool.
The one thing that's fun about real estate is there are infinite ways to make deals happen.
Mm-hmm.
Right? Your creativity is the only limitation.
There you go. All right. So again, we both see buying opportunities, some in the debt structure, some in single family homes. I think it'll be an opportunity to be aggressive. When people are afraid, I get greedy. It's that classic Warren Buffett quote, which I think is real funny. I think our discussions in December were like, man, we're at the top. And now we're like, ooh, opportunity. It's just how fast this thing changes.
Well, but there's a distinction that I think is important, at least in my opinion.
Yeah.
This is fear-based.
Yes.
The fundamentals are the same.
Mm-hmm.
People still need a place to live. There's still a housing crisis in California and many other states.
Oh, yeah.
And so the fact that you can buy the same asset but have better debt terms and the fundamentals for where the long-term economy is going in the market, and the population, growth and income growth in a particular market are still the same.
Oh, yeah.
Especially if you have a 5 or 10 year time horizon.
Oh, for sure.
It's just an opportunity, and I love how real estate moves slowly.
Yes.
It's not like the stock market. I still own Facebook and Google stock.
Yeah.
And the fluctuations in the last week have been insane. But here's what happened. All the properties I own still continue to kick out the same exact cash flow they did over the last, 6 or 12 months. And it's even improving over time.
Yeah.
And our investors are really happy. I'm really happy because it's just a stable, consistent story. It doesn't change based on the whims of the stock market. So
this is just another example of why I could never be a stock market investor, because I would literally be staring at it every minute of every day. That's just why I don't do it. So I like the slowness of real estate as well. All right, let's put that behind us. Right, we'll see if it's still top of mind next week. We can go deeper, but let's talk about taxes. When you talk about doing your personal taxes or your entity structures, and you now do this full time, what have you seen? Real estate professional, just when you think of taxes, what do you think?
Well, I love tax season, personally, and I think most real estate investors, certainly active real estate investors, probably have a similar opinion, because it's kind of like typically as a W-2 employee, you go into tax season and you're thinking, man, what am I going to be paying in taxes this year?
Yeah.
And it's going to be a big number. And I had a great year and I'm feeling good about myself and my future, but man, I'm going to be paying a ton to the state of California and federally.
Yeah.
And when you move outside of or add on top of your W-2 income, real estate holdings, private business holdings, you really open yourself up to lots of beneficial tax treatment. And lots of opportunities to reduce your tax burden and ultimately really grow your wealth. So overall, I'm happy about tax planning and tax season, but it has been a gradual journey. Like that doesn't mean it's not brain damage. It doesn't mean it's not painful. It's work. You're working for those extra dollars that you keep in your pocket. But with the real estate professional status, it's a superpower. It's a superpower. And I'm not a tax professional, but from my understanding, it really is a superpower when it comes to tax purposes. And so I'm personally in the process of filing our personal tax returns and then all of our business tax returns as well. And I think we're going to have a very positive year for me personally, and also for our investors. So that's kind of high level.
Yeah, I love the superpower idea, and I've read about the real estate professional for years. I actually was an accountant for many years out of college, not a tax accountant, right? A general ledger accountant, but you kind of understand it. Your mind kind of thinks debits and credits and all of that stuff. So I've often dreamed and thought about it, and quite frankly wondered, is it as good as people say? So I was able to use Real Estate Professional last year because I only had 1 month of a W-2, right? Just January before I left. And then I just filed, we haven't completed it, but I've done the heavy lifting this last weekend, and I got a sketch of what's the results will be. And the Real Estate Professional is absolutely a superpower. I don't know the exact number, but let's just put it out there. There's $50,000 in what would have been post-tax expenses when I was a W-2. That is now, top of line expense, business expense, now that I'm a real estate professional. And if you don't understand the difference, do the math, right? I was spending after-tax dollars before, and now I'm spending pre-tax dollars. So it is absolutely as good as you think it is. But if you're a full-time employee, as we talked about yesterday with Anna, don't try to skate around it. The IRS will hit you up for an audit, which won't be fun, I'm sure. So the real estate professional is as good as people say.
Have you ever been audited?
I've been audited twice. Yeah, back when I was a W-2 employee. Yeah, twice.
Are you open to sharing that experience?
Yeah, the first time you get the letter from the IRS, it says IRS, and my first letter was this thick. With this thick, and I was like, oh shoot, what's this? Because I didn't know what it was, right? And it basically opens up. It's your tax return stapled to it's a letter, and it says you're guilty till proven innocent, we think you owe $157,000. You have daily interest accruing. We recommend you pay this, or you can talk to your accountant and dispute this. I turned white as a ghost, right? I had the money. I could have written the check, but it would have taken everything we had.
Yeah.
And I was almost scared enough just to write the check, because you think IRS, you think garnish wages, you think you're going to jail, debtor's prison or whatever. At least that's what I was thinking when I got this letter. Like, oh my God, what I do, right? So I got my accountant on the phone. It was really, I left him a voicemail. He didn't pick up. He called me back and he goes, who died basically, right? You were frantic on the voicemail. I'm like, I got this letter. He sent it to me and he goes, hey, no problem. Over the next 3 or 4 weeks, we document what we thought. And, after 2 or 3 months, you get a letter back. It says, thank you for the resolution. I think that one I owed $187 when it was all done. It happened again like 4 months later. And their system double counted something. So we explained it and I owned zero. But it is frightening. But, my experience with the IRS is they're very, very logical, right? They're essentially accountants that want to understand the rules, and their systems spit out things that they think are abnormal. And I guess I shouldn't have been as scared as I was, but man, I was freaking out going, oh my God, I owe 157 grand to Uncle Sam. How can that be possible? Right. After I paid, a significant chunk, in the filing. So it was frightening. I could still sit here and remember being how scared I was.
Well, thanks for sharing that. I'm glad it was a good outcome.
Oh yeah. Yeah. I mean, the second one was zero, right? So, but yeah, again, the part of that is because I don't, like when I talk to my accountant, they're like, how comfortable you are, because you can always make decisions that are kind of gray with accounting. I choose not to do that. My choices are very black and white, and perhaps I pay a little bit more than I could if I fudged a little. It's just not worth it to me, right? I want the decisions to be black and white. I don't want to have to go back and suffer one of those things again. And yeah, am I an idiot for that? Perhaps, because chances of an audit aren't great. But I don't want that risk.
Yeah. Yeah. And I think so. The way I think about it is, it's part of tax planning and preparation is part of my business. So
well said.
You mentioned the difference between when you're a real estate professional, essentially your real estate business is your business.
Yes.
Right? So you get in the car and go to a property, you take a flight, you eat lunch, you meet with a potential investor. These are all expenses of the business.
Oh, shoot, the Wi-Fi that you and I are using, right, to have these discussions.
Home office, your Wi-Fi, your like all of your equipment, your materials, your
phone.
Those things are your business expenses. And therefore, like you said, you bring those above the net income line, and those become things that are paid with pre-tax dollars.
Huge difference.
And so now, when you have that responsibility, or when you have that opportunity, you also have the responsibility to document clearly
absolutely
what the expenses are, what they were for. And if you have that in a file that is readily available and it's legitimate, then an audit is simply a matter of pulling the file and reconciling and showing, here's what we did and here's why. And we did it the right way.
Absolutely right. It's funny, the routine now I have when I go out to lunch with clients or investors or whatever, it's the same every time. I get the bill, and before I sign it, I write down on my copy everybody's name, what properties we talked about, right? All that discussion, right? And then it goes in one file at home. Yeah,
so I think it's like good record keeping is really important.
Yes.
I'll mention to you, tax planning for us, like I think about it personally, but then we go through filing tax returns for each of the individual LLCs that we own. And then we also go through the process of providing K-1s to each of our investors. So it's a meaningful amount of work for us.
Sure.
We'll probably have, I don't know, 100 K-1s to distribute this year.
Wow.
So that process is interesting too, because there's a timing component. If I don't get my K-1 out to you as an investor in time for you to file your personal tax return, man, I'm becoming a burden to you.
Yeah. And are K-1s due by January 31st? I don't know.
No, they're not. They're not
Oh,
due. They're not due by any particular time.
oh,
It's
interesting.
simply a matter of you need your K-1 in order to properly file your tax return.
Correct.
So we need to get it to you with ample time for you to do that.
Yeah.
And otherwise, you're going to either need to make an estimate, which can be amended in a later year,
Mm.
or delay your filing.
Yeah, an extension. Yeah.
Yeah, file an extension. So
Oof.
there's some burden there. But the interesting thing is, for our investors, who most of which are W-2 employees,
For sure.
we use, I'm curious if you use cost segregation or any kind of bonus depreciation.
I use bonus depreciation heavily. Yes.
Okay. And it depends on the model, and cost segregation studies have gotten cheaper recently, especially for single family homes.
Mm-hmm.
But we use a cost segregation study on every property we have, which basically buckets your depreciation instead of a straight line depreciation of on a single family home, I think it's 27 and a half years.
Mm-hmm. Correct.
Line depreciation. You essentially categorize all of the depreciable assets
Mm-hmm.
into buckets, and then you are able to, with bonus depreciation, take a big chunk of the depreciation in year one.
Yeah.
So like what we have investors who maybe put $50,000 into a deal, and in year one they get a K-1 that shows negative $46,000.
Yeah.
So for their tax return, they are reporting minus $46,000 return on their $50,000 investment, despite the fact that they're getting positive cash flow from the asset. And so
Yeah.
it can become really powerful.
Yeah. So I this curious question. So again, I was a W-2 employee, made more than the minimum or maximum, whatever it was. So I couldn't claim the depreciation under the past IRS rules. I'm curious, with the tax changes just happened under Trump, can those W-2 employees actually take that $46,000 loss against income, or do they have to carry it?
No. So
Yeah.
again, I'm not
Okay.
a tax professional. Don't
Yeah.
take my advice blindly. This is my own knowledge and understanding and opinion.
Yeah.
So as a W-2 employee,
Mhm.
your income or losses from a K-1 are passive income or losses,
Got it.
and they can only be used to offset other passive income or losses.
Yeah, that's my
So
understanding as well.
now, as a real estate professional,
Bingo. Yes.
your losses on a K-1 can be used to offset any income tax liability you have from
Hence
any
the superpower.
superpower. So just to compare, let's say I'm a W-2 employee and you, Michael, are a real estate professional.
Yep.
And we both invest $50,000 into the same deal, and we both get the same K-1.
Yep.
Mine shows negative $46,000 in year one, and yours shows negative $46,000 in year one. For me, I'm only going to be able to offset the amount that I earned in passive income if I had any.
If you had any. Yep.
If I had any. For you, you could offset the entire $46,000 if you had that much tax, that great of a tax. And that's exactly right. There's a superpower.
Yep. And I did that this year. I didn't use cost segregation. My deals are small enough where it doesn't make sense economically. I used bonus depreciation for capital expenditures and repairs. And let's just say I wrote off 6 figures in bonus depreciation this year, which went right to top line, reducing the top line. So superpower. I'm going to steal that. That actually might go in the top. Superpower. That might be the title of this video or something.
Well, one thing, Michael, you might want to look at is historically, cost segregation studies are, we pay between $4,000 and $10,000 every time we do one.
Yeah.
Because properties are large.
Yeah.
But there are now off-the-shelf kind of products.
Okay.
For single-family homes that are like $300-400 a pop.
Okay.
And so you might, I can send you a couple resources afterwards.
Please do.
You might want to look into it, because
I will do that.
it won't get you 100% of what you potentially could get with a proper manual cost segregation study, but it'll get you 80% of the way there.
Yeah, and at this point that'd be close enough, I think. So very cool.
Yeah.
I'd look forward to that. Any other things we should hit around taxes for folks, you think, in this discussion?
No, I mean, I think it's one thing I do recommend is Tax-Free Wealth, Tom Wheelwright's book.
Oh yeah, I've read that.
I think it's really kind of eye-opening.
Tax-free wealth, right?
Yeah, Tax-Free Wealth. I think he has several different versions or editions of it over the years.
Of course, if one book sells well, you just create another one.
Well, yeah, and tax law does change, but
Yeah.
that is an interesting read. I mean,
Okay.
if you're serious about your wealth, you need to understand tax.
Oh, no question.
So
Yeah.
like whether or not you think it's boring, you need to like move that out of your thinking. It doesn't matter. Like you can't get around it. It's a huge opportunity. And once you kind of embrace it as an opportunity, all of your tax decisions start to become investments.
Yes.
As opposed to just like, it's tax time. I have to go do this. They become less burdensome.
Yeah. Being a W-2 employee with a decent income and going to see your tax accountant is unpleasant. Being a real estate professional and going to see your tax accountant is awesome.
Let me just mention one other interesting wrinkle, and I don't want to get too far into the weeds, but I mentioned you can only, as a W-2 employee or a non-real estate professional, you can only offset your passive losses with your passive income.
Yep.
So what we see some of our savvy investors do is they attempt to balance their passive income with their passive losses. So another way of saying this or thinking about it is using the example with me as the W-2 employee and you as the real estate professional.
Okay.
If in that year where I invested $50,000 and I got a negative $46,000 K1,
yeah.
If I would have had $46,000 of passive income that year, those two things would offset each other.
For sure.
And so the superpower is in a way available to me. It's not quite as strong as yours, but it's there. And once you start to understand how to play that game, things start to get really interesting. And you don't actually have to be a real estate professional. You can do it. As a non-real estate professional.
Yeah. Very, very cool. Talking taxes as a real estate professional is a lot of fun. I don't know that I would have done this back in the day where AMT was a thing and I'd always have to pay AMT. I didn't like that. I didn't like those tax seasons. Thank goodness that's not there anymore for me. So, Matt, thank you very much for doing this. Thank you for being a part of our expert series and talking every Thursday. It's been a lot of fun.
Yeah, absolutely, Michael. Thanks for having me.
You got it.